welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex, stocks and commodities in multiple destinations. I'm Michael Hewson. Joining me this week again is my old friend Pepperstone Senior Market Strategist Michael Brown. So Michael, markets looking broadly positive again this week. FTSE 100 appears to be finding a little bit of resistance around about 8,400, where it seems to be finding a little bit of a cap since we posted those record highs in April. Rather, we've tried at least 4 occasions to get through that level, but we haven't really seen the momentum sustained.
Yeah, indeed. Very, very good morning to you, mate. Your intro sounded like you were almost trying to get rid of me and, get someone else in there. But I am back once more.
You're the one who's got to go to lunch somewhere.
That is very true. Hence the outfit for our listeners. I'm doing this podcast in a suit and tie today, which I've worn about 3 times this year. But no, it has been a pretty positive week for the markets. Obviously, we're in that kind of silly season now between Thanksgiving and Christmas, where a lot of people are, closing off positions and squaring up their books and really thinking about, how many various social events they're going to attend over the next 3 weeks, which I'll be honest is exactly what I'm doing today.
Yeah, it's something that I'm going to miss out on to a certain extent this year, though I've got a couple of lunches and dinners for next week. So, maybe I'm just playing a little bit of catch up, I guess, after a slow start to December. I think change of lifestyle after 12 years as chief market analyst at CMC, and now a slightly slower pace of life.
Exactly. And I think you've very much earned that, mate.
I think I have as well. Anyway, before we get cracking, because everyone's talking about the old Santa rally. I've lost count of the number of times I've been asked about that over the years, and there's an article on the Good Money Guide website by my colleague Jackson Wong about Santa rally, and I understand that Chris Weston at Pepperstone has also done a similar article on the subject of a Santa rally. Before we get into that, obviously I have to do the
we're going to get in trouble otherwise, aren't we?
Yeah, I know. We got to stay on top of the housekeeping, so to speak. So the information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content, as well as puns, to seek their own advice. Spread bets. Sorry, I couldn't resist that. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 75.1% of retail investors' accounts lose money when trading spread bets and CFDs with this provider. I always think there should be a risk warning to your puns anyway, so I thought I'd just chuck that in there.
Well, certainly a risk warning or a health warning, one or the other.
Yeah, indeed. So getting back, because obviously we're going to look back as well at some of our preview of last week. So Frasers Group, Balfour Beatty. There's been some big movers this morning, and we'll get into that. But as I said, markets winding down for Christmas. Markets are still making new highs. The S&P 500, the DAX continues to make new record highs above 20,000, which some would say is a little bit surprising, I think, given the fact that the German government is pretty much in deadlock. The CAC 40, on the other hand, isn't doing so well. After hitting record highs back earlier this year, it's been on a slow decline pretty much since then. And again, obviously, there's the news about the French government and its own, I think, governmental problems. We'll go into that as well a little bit as well. But let's talk about the Santa rally. Thoughts, Michael? Is it a thing, or is it just a nice little thing that the media likes to talk about to generate clicks?
Well, I think it's the latter, to be completely honest with you. Now, I mean, I wouldn't dispute the fact that we do tend to see markets trade pretty well in the back end of the year. I mean, I think I was reading the other day that between the Monday after Thanksgiving and the 2nd of January, so that kind of final stretch of the year and into the very early part of the new year, over the last 50 years, I think the average performance for the S&P over that period is a gain of about 2.3%. So it's undeniable that there's something there. And of course, naturally, when it be a journalist or a strategist, I'm sure we've both been guilty of it in the past and probably will be in the future, you're always looking for a bit of a narrative to tie in with a price move. And obviously it's around Christmas, so calling it a Santa rally is kind of natural. I guess the bigger question is what drives it. And I think for me, there's a couple of things. One is people who are just trying to chase and eke out that last little bit of juice out of the market before Christmas. And the second is this idea of sort of portfolio window dressing, whereby active fund managers who might have underperformed throughout the year, when they write their year-end investment letter, they don't want to explain why they're not holding Nvidia or Meta or whoever some of the other big sort of market darlings are at the time. So you see a lot of buying of those stocks, the best performing stocks, to effectively window dress a portfolio and make things look a little bit better than they are. But yeah, it's undeniable that, we do tend to see markets trade pretty well in November and December.
Yeah, I also think the concept of trend is involved as well. I've looked back over the last 10 years at the December performance of stock markets, and I've highlighted 4 years, 2014, 2015, 2018 and 2022, when the FTSE 100 actually finished December down on the month. So, I suppose it's all about timing. In Jackson's piece, he says the Santa Claus rally for 2024 generally tends to span either the 24th of December to the Monday, the 6th of January. Well, I wouldn't call that a Santa rally. I call that a post-Santa rally. And yet your colleague Chris talks about the 20th of December until the 6th of January. So again, but I can always remember being asked about it from pretty much early December. I remember a particular interview with Sky News, I think with Kay Burley it was, when she was doing the business, and she asked me about whether or not I believed in the Santa rally. And I said I was skeptical about it. And she said, and just like to remind our listeners, our business guest didn't say he didn't believe in Santa. For the children out there, he didn't believe in the Santa rally. I just love that clarification. But I guess for me, it's about trend. If the markets are trending higher, then generally December tends to be a fairly decent month.
Yeah, no, I think you're absolutely right. I hope you can still hear me, by the way. I was having a few technical issues while you were talking there. Good. Yeah, I think you're absolutely right. And actually, one of the things that we've seen a lot over the last, kind of 12 or 18 months is the degree to which a market can and tends to be underpinned by momentum. Whether that be equities or any other market out there, we do tend to see that phenomenon quite a lot. And I agree. If you have had a positive year, then you tend to see a positive end to that year as well. And I guess that's what's panning out in not just on Wall Street, but really everywhere at the moment. You mentioned even in Germany, where you'd say, well, we have said on this podcast that the economy is in a depression. We still see the market notching record highs.
And I think, when I've looked at the performance of the markets this year, and we'll talk about that in subsequent podcasts in the coming weeks. But certainly, I think, in the second half of the year, after a bit of a sell-off mid-July, markets have pretty much gone one way, albeit with a little bit of volatility. They've tended to trend higher. So you've got the S&P up over 25%. Even the DAX is up around about 15 to 18% year to date.
Yeah.
So certainly in the context of momentum, I think that is very, very important. Jackson's looked at some of the stocks that generally could do well as a consequence of a Santa rally. He's looked at the S&P 500. Obviously, he's pointed out Nvidia. I mean, who wouldn't? But you sort of got to ask yourself whether or not there's an awful lot more momentum in that particular stock for 2025. And he's also, in the UK, pointed out Glaxo last year was up 4.8%. JD Sports was down 10%. So, and then you've got Marks and Spencer's, which was up 4.5% as well. So, and then Frasers, which was down 6.2%. We'll talk about Frasers in a minute because they reported their results, and the markets didn't particularly like what they heard. But yeah, I mean, you've got to be selective, I think. And you've got to do your research, as with anything related to the stock market.
No, absolutely. And I think the other thing that I would just mention, particularly you see these phenomenons, or phenomena, I suppose you should call them, and then eventually they are front run, and then eventually that erodes. So something in the foreign exchange market, for example, month end flows around the London fixing. We all know that those flows are now coming, so they get front run by half an hour, a day or so, and actually now there's not really much sort of signal to be generated at all from what we see towards the back end of the month, and you just wonder whether over time that may happen with this as well.
Okay, so that's the Santa Rally. Have a read of it on the Good Money Guide website. It's a fairly good read, and ultimately, I don't think Jackson draws too many conclusions from it, whether it's positive or negative. I think the important takeaway for me: do your research, whether whatever the narrative is coming out of the markets.
Absolutely.
Okay, so let's have a quick look back at what we looked at last week. And unsurprisingly, manufacturing and services PMIs weren't particularly great, either in Europe or in the UK. If we look at the UK, for example, we hit a 9-month low in manufacturing, weak demand, services optimism, business optimism's at a 2-year low, employment dipped. So again, it's a
Well, thank
disappointing
you for
set of
that dose
numbers.
of festive cheer, Mr. Hewson. That's what we all wanted to hear this morning, I must admit.
Oh well, I mean, I'm just repeating the numbers, mate. And these are the numbers as they are. So I think when we look at those numbers, what do they tell us about the ECB's reaction function for next week?
I don't
That
think
was
it.
my segue, by the way.
It's a very good segue. I don't think it changes a great deal for the ECB, to be completely honest. I mean, it's clear that the data is it's dismal. Let's be honest, nothing
Mm.
short of dismal in the eurozone. But fundamentally, the ECB were always going to cut by 25 basis points in December, and they're probably still going to cut by 25 basis points in December. I think the conversation around policy in the eurozone is one of, are they now going to need to go below neutral, which you take to be around 2%? And the weaker data gets and the more unstable the political backdrop gets, certainly in France and in Germany, you would argue the more likely it becomes that they are going to need to take rates back into what you would call easy territory. And I think that's really the focus now is, how deep below neutral do they actually need to get?
Yeah. With the ink on the recent report from Christine Lagarde's predecessor, Mario Draghi, he talked about um, his diagnosis of Europe's ills was timely and it was accurate. Unfortunately, the ECB is in no position to deliver on it
Mm.
in terms of creating efficiencies, if you like, in the European economy. And neither are politicians, for that matter, because I think at some point we're going to need new elections in Germany, new elections in France, and until we get some flavour of what any new government is going to look like, you can publish as many reports as you like. Ultimately, you need actions and not reports. And the ECB can only do so much. So whether they cut by 50 next week or 25, I think it's 25. We've got Martin Kazaks recently, who's the Latvian ECB president. He's generally tend to be more on the hawkish side, and he suggested that a 50 basis point cut will be discussed. That doesn't necessarily mean it'll happen. We'll get 25. Lagarde's comments last night, again, didn't really shed any light on what the ECB might do next week, but I certainly think 25 is nailed on.
Yeah, absolutely. I think 25 is probably nailed on for the next 4 meetings, really,
Mm.
until next April. And then things start to get a little bit more interesting. But yeah, and also just on that, we'll discuss a 50 basis point cut line. I would hope they are going to discuss a 50
Yeah.
basis point cut. And actually, I would also hope that they discuss doing nothing. Because as policymakers, you should be keeping all your options open and surveying the data and looking at it in its totality, not going into a meeting with already knowing with certainty exactly what's going to come out of the meeting.
Okay, so we've jumped slightly ahead, but I thought wanted to bring those two topics
Yeah.
together because I think, they work well together.
Mm.
Even though we were talking about last week's look ahead and this week's data. And let's look at the companies. Now, we highlighted Frasers Group, didn't we? Mike Ashley's
Hmm.
Frasers Group, in the, sort of in the aftermath of all the other retail announcements that we've seen over the course of the past few weeks. And ultimately, they're going to be leaving the FTSE 100. We talked about the reshuffle.
Yes.
Um, the day after it's confirmed, the shares are now down 13% because they've revised their profit guidance down for this year only by 25 million. But it was interesting to note that group revenues fell 8.3% across the board to 2.54 billion. There's significant declines across all its brands, but also further out next year, they're adding another 50 million in costs because of the result of the budget, and they're citing weak consumer confidence, despite the fact that they've improved their margins. So, a 2-year low, I think the shares dropped to today.
Yeah, do you know what? Reading the results and the commentary around the results, you could almost take out the word Frasers and put in any UK retailer because basically all the commentary from the sector is the same. Our costs are going to increase because of the budget. Consumer confidence is weak, and trading conditions are a lot tougher than we expected. And I think that's just being mirrored broadly across the sector. The other thing that's not helping Frasers Group in this particular instance is the fact they're going to be dropping out of the FTSE, because that means there are forced sellers in the market now. Passive funds that track the FTSE will have to hold the stocks of the 100 constituents of the index. Now that Frasers Group are not going to be a constituent of the index, those passive funds are going and buying whatever's coming in. I think St James's Place is coming in, and a couple of others. So they are rotating away. And again, that's exerting further downward pressure on something that's already been pretty badly beaten up on the back of the results.
Games Workshop is coming in as well, and that's been actually a fairly decent performing retailer
Mm.
this year. So it's not all bad news on the retail front. And certainly, I think if you look at some of the retailers this year, they've done very well. Marks and Spencers have had another good year, following on from the good year that we saw last year. So it's not all doom and gloom. So
Mm.
while we're sort of berating the government, because of their economic policies, there are bright spots in the UK stock market, and I think it's important to remember that. And ultimately, I think it could be good for Frasers Group to drop out of the FTSE 100, because I think over the next 3 months, we could see a rebound in the share price in the same way that Washes of Switzerland issued a profits warning at the beginning of this year. And today they're up around about 13%, and they've almost recouped all of those early year losses that we saw in January.
Mm.
So, this is essentially what stock market investing is about. Sometimes taking advantage of these share price drops, and maybe picking up some cheap shares. Obviously, you need to be selective in your research as well.
Yes, of course.
Okay, so we've also had Balfour Beatty, record highs, construction giant. They've basically they've raised their profit guidance, so that's good news. And they're implementing, very easy for me to say, implementing another share buyback. So good news on construction, a UK construction company that continues to go from strength to strength. So another good news story there. So for those of us, for those of you who might want to criticise me and Michael for being too downbeat, we just tell it how we see it. There's good news stories out
Yeah.
there, there are bad news stories out there, but ultimately I think that we both think the government could be doing more to generate an uplift for UK businesses across the board.
Yeah, no, absolutely. And as you say, there are good news stories out there, and actually we want to be talking about the good news.
Yeah,
I
we
don't want
do.
to speak for you, but we want the country to do
I
well. We
do.
want the
I
economy
do.
to be performing
Absolutely.
well. We want the market to be performing well. And that's just not happening on net at the moment. But there
Mm.
are, as we've seen this morning with Balfour's results, there are some, relatively small, but there are still some bright spots out there.
And some good news on the M&A front this morning. The Competition and Markets Authority has signed off Vodafone and Three's merger,
They
15 billion
have.
pound merger, after they gained a pledge on the part of both companies to spend 11 billion pounds on upgrading the UK's 5G network. And by God, could they use doing with spending that money.
Oh,
We were in
honestly.
Winchester yesterday. I could barely get a signal on the 4G, let alone 5G.
Yeah,
So certainly I think that's money that needs to be spent.
it very much is. But can I bring you some bad news on M&A?
Go on then.
So this is data from Bloomberg.
Uh,
This year we've had 45 companies that have delisted from the London market because of M&A, primarily a result of being snapped up by US-based PE firms largely. That's up 10%. Well, this data was as at the end of November, so it's 11 months of this year, and that's up 10% on where it was for the entirety of the last in 2023. And it's also the highest absolute number of firms to have left the London market since all the way back in 2010. So yes, Vodafone 3 is good, but I think structurally the London market is still really, really struggling.
there is some more good news. UK equity inflows were positive in November for the first time, I think, since May 2021, according to Calistone. According to Calistone, I read that on Bloomberg this morning.
that
When you
that
said
is
that thought popped into my head. Um,
just to spend a second on that. That is ridiculous that we've gone 3.5 years of monthly net outflows from UK
it's reversed the
markets.
outflows on the previous month in October. So,
Yeah, first of many inflows
maybe,
though. Hopefully,
so hopefully that is sustained going into 2025. However, given some of the narrative coming out politically across Europe and the UK, you'd like to think that it will continue, but
yeah.
we'll have to wait and see as
Time
we head
time
into
will tell on that
2024.
one, won't it?
Indeed. So obviously we've got the ECB rate decision next week, 25 basis points. Now we're going to look at the week ahead. And we've also got US CPI. Now, obviously, we're recording this before the payrolls reports come out. We had Powell last night, Fed Chair Jay Powell last night, sounding a little bit hawkish when it comes to the employment part of the mandate. He says the economy's held up much better than they anticipated. And consequently, that may mean that even if they do cut in 2 weeks' time, that could be the last one until the middle of next year. What's your thoughts on that?
Yeah, it's interesting because the Fed are in a little bit of a bind at the moment, whereby we all know what we think is coming in January, which will be tariffs and tax cuts. So you'd expect stronger growth on the back of the tax cuts initially, and then potential upside inflation risks in the back end of next year as a result of the tariffs. Now, the problem is for the Fed and for all of their various economists that they've got working there, you can't model it at the moment because we don't know what the policy will be. And you can't make monetary policy on the back of it because the policy isn't actually confirmed. It's all sort of sources, reports in the Wall Street Journal and whatever. So I think what the Fed are trying to do is just build a lot more optionality into their policy making going into next year. Whereas, if you think about what the Fed have been saying for the last 6-9 months, it's been the economy's doing okay. We want to make sure the economy is still doing okay. We think inflation's going back towards target. Therefore, we're happy to cut rates. They now need to kind of come a little bit more back to the center ground and say, the economy is doing okay. We still think it's doing okay. We are protecting those gains as a result of having delivered, well, what's currently 75, but by the end of this year will probably be 100 basis points worth of rate cuts. And then to actually say, there are some more two-sided risks around the outlook. There are now more uncertainties. And as a result, we're going to take things a little bit slower and a little bit steadier as we move through the early part of 2025. And I think Powell's remarks last night were just the first very, very small step on that journey. I mean, if you think about it, this is not something where Jay Powell can suddenly come out after months of saying all the risk is on the dovish side. He can't then suddenly come out and say, well, we might pause in January. That's going to cause a tremendous amount of market volatility. This is akin to, trying to turn around a cruise ship. You have to do it very, very slowly and steadily in order not to sort of spook and surprise market participants. Oh, no. Oh, dearie me. I was trying to steer clear of the puns there, but, oh, God.
I usually use oil tanker because obviously it takes I mean, the US economy obviously is the biggest
To
economy.
be fair, it would have been slicker if I used the oil tanker, but,
Oh, here we go.
It's barreling downhill now, isn't it?
It's it certainly is. So we've got US CPI next week.
Yes.
So I would expect that to see a modest uptick. I mean, unemployment's still well below the Fed's target, I think, for this year end, which I think was four. I think you mentioned it was 4.4%.
Yeah, it was in the SEP.
Yeah.
Yeah. Yeah, so I mean, something pretty disastrous would need to befall the US economy in the next couple of weeks in order for their forecast to be achieved.
So I certainly think, we're probably going to get a cut in December. Whether or not we need one, I'm not convinced either way. And I think there will probably be some on the FOMC will probably argue that very case. I was reading a couple of comments on X, Twitter, the other week that were talking about the possibility of rate hikes next year.
No.
Personally, I don't buy into that. Certainly, I think Andrew Bailey at the Bank of England is suggesting that rate cuts might not be as many as perhaps the market is thinking. And certainly, I think next week's monthly GDP numbers out of the UK, I think for October, are likely to be sobering reading for the government, despite the OECD's comments earlier this week.
Yes, I agree. I think the interesting thing, so, there is a little bit of policy divergence going on now because you've got the Fed who, we're talking about, are they going to pause? Are they going to skip a meeting? We've got the ECB who we were saying, they're going to cut every meeting and then probably get to neutral and keep cutting because the Eurozone economy needs it. And then you had, as you alluded to, Andrew Bailey in the FT yesterday saying, 4 cuts next year is probably a sort of reasonable assumption and they're going to continue at a gradual pace. So I think it's, again, an interesting dynamic looking to the year ahead where you go, again, this year, all the risk has been obvious. It's been everyone's going to cut roughly the same amount at roughly the same pace. Well, next year, that's not going to happen. So this idea of a sort of policy put that we've had this year to underpin sentiment, that's not going to be there anymore, I don't think.
No, as you said, I think probably more two-sided. I mean, the ECB, the cutting cycle did start late, didn't it, this year? It didn't start till June. So, expectations about cuts in the first half of next year, there probably aren't going to be as many unless something drastically bad happens. And I could certainly make the case for rate cuts in the UK if the economy slows and dips into recession, perhaps. But ultimately, I'm not really sure how much help that will be in the wider context of an economic slowdown.
Well, I'm not sure it would be much help at all, to be completely honest with you. And actually, there's also a case to say that it could do more harm than good, because if you end up with anemic or no economic growth at a time when inflation remains elevated, I mean, that's a horrible cocktail to be trying to deal with. And if you cut rates into that, you're just going to embed those price pressures, which will probably make the recession more painful than it otherwise would be.
Okay, so we'll move on from that because it's a fairly light week next week. As I say, we've talked about US CPI, we've talked about the ECB, and we've talked about UK GDP. And even the earnings numbers are now starting to really thin out as we head into the Christmas break. But I picked one out. I picked a couple out, actually. We've got British American Tobacco. First half numbers, they've actually had a fairly decent year if you consider where they were at the beginning of the year. But a year ago, the shares did fall to a 13-year low on the back of a profit warning and a decline in global smoking trends. We've seen a bit of a rebound since then, capped around about 3,000 pence, £30, finding that a bit of a barrier. I think the key thing for me here is new generation products. They said a year ago that they're looking to, I think, grow their revenue in that segment to between 5 and 10% by 2025. That looks ambitious. They still make 80% of their revenue from tobacco products, and obviously the environment for that, given Rishi Sunak's smoking legislation, is likely to be replicated across the rest of the Western world. So, the opportunities for growth there fairly limited. Pays a fairly decent divvy, though.
Yeah, well, I was just going to say, firstly, for those who are unaware, NGP is effective new generation products, effectively things that aren't cigarettes. That's
Vapes.
exactly vapes is exactly what they're talking about. And I think that the dividend aspect is something that could underpin them to a degree. But as you say, the opportunities for growth there, not just in the stock but in the sector, do seem somewhat limited.
So finding a bit of a natural barrier around about the £30 level, so maybe that's due for a little bit of a rollover. Be interesting to see what the CEO has to say about that.
Indeed.
GameStop, third quarter 2025. I mean, I'm looking at those shares, and I've got to say that is a roller coaster and a half. Um, we did see earlier this year a huge spike in volatility when it was reported that Roaring Kitty,
Oh
aka
God,
Keith
yeah.
Gill, came
I
back
forgot
onto.
about him.
Yeah, exactly. I can recommend actually. There's something on Netflix called Dumb Money. It's a really good film, and it's
Oh
really
right.
about the story surrounding that.
Oh okay.
Quite informative, obviously, the collapse of the hedge fund.
Mm.
But looking at the numbers themselves, they don't make great reading. Revenues are declining, it's barely breaking even, and it's around about $20. And when you consider where the shares were back in 2021, that's a huge fall from growth.
Yeah, absolutely. I mean, the figures. I'm just reading your note that you sent to me earlier. The figures are pretty grim, to be completely honest with you. But I would also say that I doubt there is anyone out there, or there are certainly very few people out there who are buying GameStop based on what their earnings say. It is very much a case of being, influenced by whether it be tweets or YouTube videos or whatever else. But one thing that their management have been pretty clever at is capitalizing on that. They're maybe not anymore, but at one point there was insatiable demand for their stock, and the management cashed in and did rights issues and all the rest of it at that point. Whether the earnings actually make a blind bit of difference to where this thing's going next, I don't know. I mean, it feels like a bit of a random number generator at the best of times.
I think this is a classic example of a momentum stock that
Mm,
generally tends to trade according to sentiment around
mm.
it. And it's less about the fundamentals and more about, I think, the mood of the market.
Yeah, absolutely. But I think, well, without wishing to steal your thunder, Broadcom next week are going to be a lot more interesting than that.
No, absolutely. We'll talk about it by all means. I
Well,
mean, you've
well,
got
no. I
most.
mean, go. You've got the preview there, but what I was going to say is, I think it's again the sector is absolutely pivotal to the market.
Mm.
Whether it be Nvidia, Broadcom, AMD, whatever. They've all traded very, very well over the last 18 months as a result of this big, AI boom, effectively. Now, again, and we've spoken about this a lot on the podcast this week. The risks around that story are becoming more two-sided. Is the demand going to continue growing? It feels like we had this conversation about Nvidia as well. Is demand going to keep growing at the pace it is? Are they going to be able to keep up with that demand, etc., etc., etc.?
Well, I mean, Broadcom's gains in its share price have been helped by the fact that it purchased VMware, so
Mm,
that essentially has helped double its revenue base, and accounts for the share price gains that we've seen over the course of the past couple of years. It does appear to have found a little bit of a natural cap at around about $190, but nonetheless, I think for me it's about the growth, the growth potential going
mm,
forward, because ultimately, while it makes an awful lot of its revenue from semiconductors, that's only around about 52 or 53%. The other part of it is its VMware acquisition,
mm.
which contributes around about 47% of its revenue. So for me, Broadcom is a slightly more diverse business when it
Yeah,
comes to comparing it to, say, Nvidia. But ultimately, it's about the AI story here,
yeah.
and the AI story will definitely drive it. And one of Broadcom's biggest clients is Apple.
Mm. Yeah, of course. Yeah, and they are going, all in on AI at the moment, aren't they, Apple?
Yeah,
So yeah, we will see what happens there. But I think I'm right in saying, from a sort of broader level, that Broadcom are probably the last big earnings print out of the States this year. I think we've got Macy's on Wednesday as well. Obviously, they were delayed because
yeah.
of that accounting issue that they had with some geezer committing a huge amount of fraud. But
Mm.
I'm pretty sure once those two are done and dusted, we're sort of out of the woods of earnings season until the banks get things underway in January.
Yeah, or well, not just the banks, but we're also talking about the retail story. So in the
Mm,
first week of January, the first 2 weeks of January, you get the Christmas trading updates from the likes of Marks and Spencer's, Tesco's, and
yes.
all of the other big retailers, and that will give us a flavour of the outlook for the retail sector as we head into 2025. I can always remember my days back at CMC. The big stories for that first week of January were how the retailers done, what sort of Christmas have they had,
Yeah.
and how do they see the future going forward? And I think that ties into the old Black Friday, Cyber Monday. That quarter
Mm,
is the most important quarter for retailers pretty much across the board because that really is a springboard, if you like,
mm.
potentially for the rest of the year.
Yeah, it absolutely is. And in the US, at least, it does look to have been a pretty positive holiday period. I think spending was up about 8%, 8.8% year on year. So it looks like spending in the US over Thanksgiving, Black Friday, Cyber Monday has been pretty strong. But obviously, the UK consumer is a very different beast.
Yeah, but anecdotally, when we were out yesterday in Winchester, I mean, it was packed. We had
Mm.
Christmas markets, various stalls out there selling people selling their wares, and generally people did appear to be spending money. So maybe there is a silver lining, and hopefully that will be reflected in the numbers when we see them at the beginning of next month.
Well, fingers crossed.
Okay, well, let's hope so. Right. Okay, Michael. Well, I think we can wind this up. I don't want to hold you up from your important luncheon.
Yeah,
Um,
unfortunately, I've got a better offer than sitting here for another half an hour with you, mate, I'm afraid.
well, I think this is the record for the shortest one yet. So sometimes, being, sometimes shorter is sweeter, perhaps.
Mm, absolutely. As someone who's 5'11", I can happily subscribe to that theory.
Well, I didn't know that. I mean, I'm 6'2". Anyway, so that's it for this week, ladies and gents. As I say, next week we'll be probably looking at previewing the Federal Reserve and the Bank of England. Um,
Are we allowed to say what's happening next week?
I don't see why we shouldn't be allowed to
Going to
say
be
what's
going to be
happening
very
next week in
special,
terms
isn't
of
it?
previewing it.
Oh no,
But
I meant with us.
oh, probably not. I don't know. I mean,
Ah,
maybe we'll talk about it offline. So, of course, that's making things really sort of cryptic for anyone who's listening or watching. Just watch this space.
indeed, something very exciting.
All right. Well, thanks again for your time, Michael, and we'll talk again same time next week, perhaps.
Indeed. Thank you, mate.
Cheers.